The severe economic fallout of the prolonged Middle Eastern naval conflict hit the European financial sector with immense force today, May 30, 2026, in a sobering annual address that sent shockwaves through regional stock exchanges. Bank of Italy Governor Fabio Panetta issued a stark warning confirming that the Eurozone's economic momentum has effectively stalled, leaving the entire continent exposed to severe downside structural risks. According to detailed macroeconomic scenario analyses conducted in coordination with the European Central Bank (ECB), Panetta stated that if the military conflict in the Gulf remains open-ended or fails to achieve a permanent diplomatic breakthrough, Eurozone inflation is on a direct trajectory to surge past a peak of 6%. This worst-case metric would completely derail years of tight monetary stabilization policies, locking European industries into a prolonged phase of stagflation. The central bank chief explained that the primary driver behind this systemic economic decay is the compounding, multi-tiered transmission of the energy shock. Because the Strait of Hormuz has been heavily disrupted for months, the exorbitant costs of alternative maritime freight, war risk insurance premiums, and diverted global supply chains are no longer localized issues. Instead, these massive overhead costs are systematically spreading into core manufacturing, agricultural fertilizer production, consumer goods, and domestic infrastructure projects. Panetta emphasized that if these structural pressures are not immediately countered by unified fiscal and energy interventions, the inflationary spike will become deeply embedded within the wider European economy, forcing a sharp contraction in industrial output and risking widespread corporate bankruptcies and massive job losses across vulnerable member states. The economic alarm comes at a time when major international financial institutions, including the heads of the International Monetary Fund (IMF), the World Bank, the International Energy Agency (IEA), and the World Trade Organization (WTO), issued a joint declaration confirming that the Middle Eastern war is disproportionately crushing poorer, net importing economies worldwide as sovereign balance sheets systematically deteriorate under the weight of emergency fuel subsidies. International capital is actively executing a massive structural shift to build a long-term buffer against these Western banking vulnerabilities and shipping bottlenecks. Regional alliances are fast-tracking alternative economic strategies. For instance, member nations of ASEAN have dramatically accelerated the infrastructure spending required to integrate the cross-border ASEAN Power Grid (APG), transforming the current global crisis into an aggressive campaign for regional energy self-reliance and complete decoupling from volatile global maritime trade corridors.